How you doing? Let's have a conversation about how the flow of information impacts an organization's operation. Please join me on this journey of knowledge dissemination. Enjoy the video. When I talk about knowledge management, what am I really talking about? Well, essentially, I'm referring to the intentional organizing of information. Intellectual capital, which can also be called intangible assets, comes in many forms, such as copyrights, trade secrets, trademarks, patents, and proprietary data. All organizations value their intellectual capital. However, establishing a direct and quantifiable link between such assets and performance outcomes can sometimes be very challenging. One success metric is a company's market capitalization, calculated by multiplying a company's outstanding shares by the share price. Suppose there is a certain point in time when a market cap far exceeds the book value. What could explain the gap? Sure, it could be the result of speculation. Maybe it's due to traders, not long-term investors, pushing the stock up. But how long could that kind of froth last? Also, what about the efficient market hypothesis, which is kind of like some self-correcting force ensuring that the stock remains at fair value? What if the gap is the result of taking into account the intangible assets that the company possesses? In GAAP accounting, shareholders' equity, also known as a company's book value, is the remaining assets available after paying all liabilities. Assets are what an organization owns or controls that have measurable economic value. Examples include land, buildings, equipment, inventory, stocks and bonds, cash and cash equivalents, and accounts receivables. Liabilities are costs to run the business. Examples include accounts payable, accrued expenses such as advertising and marketing, research and development, unearned revenue, long-term debt, salaries and wages, lease obligations, and taxes. Under GAAP, intangible assets do not seem to have a place. Actually, technically that's not true. Goodwill is a term used to record intangible assets, but that can only be done under certain circumstances, such as mergers and acquisitions. The idea of measuring the value of intangible assets has existed for decades, and there are many models out there. Let's start with a basic framework widely accepted by the industry. In 1988, the Conrad Group, a team of industry practitioners, published a Swedish book with the title Den osynliga balansräkningen. In 1990, an English version was published with the title The Invisible Balance Sheet. The book outlines three categories of intellectual capital: individual capital, financial capital, and structural capital. Individual capital consists of a person's formal education, acquired experience and skills, social competence, and ability to turn it all into action. This particular capital refers to people who contribute directly to revenue. Financial capital is essentially money. Structural capital includes things such as systems, routines, networks, and data. Structural capital is divided into three components. The first component is customer and relationship capital. That is the ability to establish and maintain stable customer relations. This makes me think of another word: brand equity. At what premium will consumers be willing to pay for your specific products and services? The second component is personnel. It's the same as individual capital, but it does not refer to individuals who contribute directly to revenue. However, it does refer to individuals who are vital to the existence of an organization. The third component to structural capital is problem-solving ability. A company's capacity to create, package, and refine its products and services. Skandia, a Swedish company providing financial and insurance services, built on the work from the Conrad Group. In 1997, one of Skandia's consultants, Leif Edvinsson, an organizational theorist, authored a piece in a leading international journal for the field of strategic management, Long Range Planning, LRP. In that article, he illustrated the approach that Skandia used to measure their intellectual capital. Others have also built on the Conrad Group's model. The International Integrated Reporting Council, IIRC, is a global coalition of regulators, investors, companies, standard setters, the accounting profession, academia, and NGOs. The coalition promotes communication about value creation as the next step in the evolution of corporate reporting. The IIRC has a very colorful interpretation. Another model was written about in the Journal of Applied Corporate Finance by Mary Adams. She is the founder of Smarter Companies, a company that provides tools to measure, manage, and optimize value creation. This illustration is an updated version of the one that appeared in the journal. Adams's model combines three distinct perspectives on business: traditional financial, business stability, and intangible capital. The models just presented are only a fraction of how others have interpreted the concept of intellectual capital and intangible assets. But no matter the design, the core purpose of a diagram is to stimulate dialogue. The significance of understanding the value of intangible assets is effectively illustrated from the results of a 2015 study by Cate, Elsten, and Nick Hill, respectively the managing director and analyst of consulting company Ocean Tomo LLC at the time of the article's publication. Elsten's and Hill's findings suggest that over the past 40 years, the value for S&P 500 companies is increasingly made up of intangible assets. Today, that figure exceeds 80%. The Conrad Group articulated the situation wonderfully. Quote, "Know-how does not become business until it meets the customer. There must be a market for the know-how, otherwise there is no business concept." End quote. Although the flow of knowledge is typically hidden, the impact is clear. Those who embrace an out-of-sight, out-of-mind attitude for corporate governance are taking a risk. Knowledge management is not a fad or something that should be confined to the realm of academia. A failure to appreciate this will most certainly result in a company being a victim of its own hubris. Thank you for watching. I encourage you to provide feedback and participate in this conversation. Comment, subscribe, like, share, visit my website. I love to hear other perspectives because knowledge is for everyone.